Hey there, it's Stefan Angelini from Angel Advisory. It's the 22nd of February. Here is another economic update. Today, we are talking about BHP after their recent half-yearly results release. Talking housing data, both here in Australia. We're going to be talking about the US-backed business activity report and the good signs that's showing in the global economy. Talking about a dead cat bounce. If you've never heard of what it is, I'm going to explain what it is, how when you get positive movement in down markets, is it something that can last? We'll talk about the buy now, pay later crackdown in the UK and the ramifications that can potentially have on the Australian market for Bnpl and the failed first home super saver scheme and just how bad the government did trying to implement that. So it is the 22nd of February. For all of you that are listening on one of the social channels, now's the time. If you want to hear the full episode, head on over to our podcast or our YouTube channel to see the full lowdown. But if you're out there just in the social world, this is only just general information. Please don't consider it as personal advice. If you want any personal advice, please go and consult a licensed financial planner at Angel Advisory. We are licensed financial planners and advisors. So if you're thinking of rejigging your investment account or you just want to speak to some professionals on your financial planning, reach out to hello@angeladvisory.com.au. Now, let's get into it. Let's talk about BHP. So BHP was the one stock that pretty much dragged down the Australian market. They're a big cap and they take up a big portion of the Australian index. And what they've come out and said is that, yes, our profit has not been as great. We are cutting our dividend. But as a result, we think we're going to sell 2 of our coal power plants. So BHP have 9 coal plants in JV with Japan's Mitsubishi that are all in central Queensland. So they're going to sell 2 of their 9. And the reason they're saying they're doing this is because, well, they want to focus on more of their high quality assets. But also, the Queensland government has put a radical hike on coal royalties. So they're getting taxed more and they want to focus on more high-quality assets. High-quality assets, they say, are commodities such as copper and nickel, things that are needed as raw materials in renewable energy and electric cars because they know that's where the future is going. So they want to be the best in that space. In talking about housing and housing prices and what's happening in Australia, we're getting lower housing starts. That's going to put a constraint on housing supply. It means it's going to be a negative for renters, and it's going to limit supply on the market for new homes. So that might be the one thing that will get property prices back up. But at the moment, with construction of new homes falling to its lowest in a decade, it just puts a dampening on supply coming into the market. So renters are really going to face a struggle there. In terms of the US, what's happening in the US stock market, US housing market, home sales sank in January for the 12th straight month. So homes are not selling. Homes are spending more time on the market. People aren't buying. If there are more homes that come onto the market over there, there's going to be an increased supply. Same demand, very low. That means house prices will then go down. But at the moment, house prices over there aren't doing too bad. So just the listings, as you can see in Australia, you might not be able to find stock because there's not many listings on the market. And that's sort of keeping prices up just that little bit. In terms of an international economic news, the US business activity report has rebounded for February. So it's at an 8-month high now. And basically what Chris Williamson, the chief business economist at the S&P Global, has said is that despite headwinds from higher interest rates and the cost of living squeeze, the business mood has brightened because they see signs of inflation have peaked already. And that recession risks have actually faded. So their businesses are confident, which is great. Also, what's happening actually internal is supply constraints have alleviated. Transport is more on the move. China has opened back up. They are willing to ship. But also delivery times are really good. And they're improving at the fastest rate they ever have since 2009. So businesses are optimistic. In terms of a dead cat bounce and the stock market. So a dead cat bounce, if you don't know what it is, it's essentially when you're in a down market and you get one really good month or a really good period of an increase in the stock market. And even though it's still a falling economy or a falling market, this is often called a dead cat bounce. But there's a really good article by Roger Montgomery on Livewire Markets saying that he predicts, that there won't be another market correction. He's just saying that things are most likely to go back to normal now. So what does normal mean? Normal means that the price of stocks will trade off usual factors such as earnings growth, the ability to meet or exceed guidance, and other expectations that are out there, some capital raisings, restructuring, and those sorts of things. So while there's no indication whether it'll go up or down, it just might just return to normal. And that means less volatility. Volatility scares the bejesus out of people. So that's why we don't want too much volatility. In terms of cracking down on buy now, pay later, the UK have just announced something the government's doing to try and protect 10 million shoppers who currently use buy now, pay later over there. So it's quite easy access to money for people who are going to use it to buy goods and services. Importantly, you might see that flow here to Australia. Just the ease of access for credit is very, very scary, because if these people get themselves into debt and can't repay it, they will be hurting their hip pocket quite a lot. So protection, that might impact that buy now, pay later sector. Let me talk to you about super. A little while ago, the government introduced something called the First Home Super Saver Scheme. This was a way for people to put extra money into their super, get tax deductions, then eventually pull it out to buy their first home. Now, only 3% of members in super funds have actually used this, meaning it hasn't been ultra successful. They tried to increase the amount you can put into super, still hasn't been successful. Why I think this happened is because it's quite complex. It's quite difficult to know how much you can do, if you should do it. Do you have the ability to? How do you get your money out? A lot of times it requires financial advice to assess someone's personal situation. And, if you're a first home buyer, you don't want to spend your money on financial advice, these cheeky old financial advisors. So that's a little one there. Maybe you'll see the government release some new, policies in their May budget around how they're going to get more first home buyers getting into the home buying market. All right. So that's me. That's the end of that update on the 22nd of February. Thank you very much for listening. Go off and have a great